Hello, this is Dave Clayman from 12 Points with another In Clayman's Terms on what is definitely a difficult day in the markets. Today is Monday, September the 26th, and I just wanted to reach out to talk to everyone about what is going on in the markets today. So the September report on Consumer Price Index was a big surprise when it came out on September the 13th, and it showed that while most had been hoping that the Federal Reserve was going to be able to stop raising interest rates quite so rapidly soon, we are still behind the curve on fighting the inflation battle. As such, the S&P has dropped 12.4% in just the last 9 trading days. That is definitely excessive at this point, in our opinion. The bond market has been equally bad, dropping nearly 10% over those 9 days. We have been calling for a low in the market in the month of September or early October, which is traditional, honestly, in financial markets. There have been signs that you typically see near at least short-term bottoms over the last few days. Breadth has been terrible. In other words, the number of declining stocks has far exceeded the number of advancing stocks. More people are buying puts options, protection for their portfolio if the market goes down, than call options looking for the market to rally. The volatility index has spiked up over the 30 level. That's another sign that traders often look for. Sentiment is extremely bearish from anybody you talk to, including Goldman Sachs finally just lowered their estimate for the year-end S&P from 4,300 down to 3,600. That all seems like revisionist history, like closing the barn door after the horse has been out when the market is already at 3,700. So what we are looking for is a short-term rally. With the elections coming up, it is possible that weakening economic data and some sign of a change in government, regardless of your political views, may give people hope that the worst has passed. That would give us the opportunity for a year-end rally. We don't believe the market is going to finish the year more than 20% down, which is where we stand right now. And then, honestly, we'll reassess our positions, and everyone should be looking to reassess their own risk tolerance based on this move. It has definitely been one of the worst years for a combined stock and bond portfolio, because typically when stocks are going down, bonds and their interest rate provide some kind of cushion. However, both stocks and bonds are down double digit this year, so there's been literally nowhere to hide. We wanted to make sure to let you know that our views on the world have not changed. The decision last year that inflation would be higher, that interest rates would go higher, and that value stocks were the place to be for the intermediate term continues to be the case. And we look forward to certainly better times. We never like a down year, but the market has finally reached what we estimate to be fair value. If you look at a 10% reduction in the current expectations for S&P 500 earnings, we believe that is the likely scenario, and therefore we have finally reached the fair value, or actually breached it a little bit with today's close. So we are here if you have questions, if you'd like to reach out and have a conversation, but we remain confident that we are nearing at least that short-term bottom that we discussed, and there will be a time to liquidate some positions for tax reasons and other before the end of the year that will position us well for 2023. Again, if you have any questions, feel free to reach out to your advisor or me directly if you'd like by calling the office at 978-318-9500, and we'd be happy to have a conversation. We wish you well throughout these difficult times and look forward to speaking soon. Take care.